Hey, I'm Rebecca, and today I want to give you 4 proven factors for selecting a winning stock. Now, you might not feel confident that the companies that you're interested in are safe picks, or you're new to investing and you just don't really have a clue about what even to look for when selecting the company to invest in. So, how you go about evaluating stock is the subject of this video today. Now, before we jump in, if you're new to the channel, be sure to subscribe and hit the notifications bell. This is your money, and I want to help you to get the most out of it. Now, as an investor, you understand that there is risk when it comes to investing, and you want to have a strategy or a method for evaluating companies so that you can minimize your risk. Otherwise, you'll end up losing a bunch of money, just like I did picking a bunch of studs. And I want to share a story with you and what I learned firsthand when I started to become an investor, okay? That way, you'll be equipped with what to do to consistently pick winners. Now, when I worked in corporate America, I invested in my company's 401k plan, and I didn't have to evaluate any stocks because I didn't invest in any individual stocks. I selected an index fund such as the S&P 500, which holds a basket full of the biggest and best blue chip companies in the United States. I put all my money in that fund, and I was good. The fund took care of analyzing all the companies that were in that fund. That's easy peasy, right? But when I became self-employed, I had to learn how to invest and evaluate stocks on my own. I didn't know how to pick stocks, so I searched the internet and YouTube, and I came across a bunch of investment channels. I started following this particular channel because the host would actually pick the stocks for you, advise you on how many shares to buy, at what price, and when to sell. They had over 400,000 subscribers, so I figured they must be onto something. So I hitched my wagon and started taking their cues directly from them. And this was during a bull run, so things were looking good for a while. But eventually the market did take a downturn and crashed, and so did several of my stocks. A few companies did an extreme reverse stock split, and there were some companies that delisted from the exchange altogether. I ended up losing tens of thousands of dollars. I had to take a step back and reassess what went wrong. And it was a learning experience, and I can only blame myself for not doing the research. So I committed at that time to learning how to evaluate individual stocks on my own, how to minimize risk by picking winners and staying away from potential duds. Now, I hear people say all the time, just buy companies that you like. Well, I like Bed Bath & Beyond, but it wouldn't be wise to invest in that company. So there's more to it than that. So let me share with you 4 factors that I use to evaluate individual stocks before investing my money. And they have to meet a certain criteria. Now, I'm not going to deep dive into these 4 factors. I just want to give you an overview so that you would have a point of reference as it relates to what you should look for in evaluating stocks. And these 4 factors are, the first one is capitalization, okay? Market cap refers to the total value of all of the company's shares of stocks. Now, it measures what the company is worth on the open market. And to calculate market cap, you take the total number of the company's outstanding shares and you multiply that figure by the company's current stock price. And I generally invest in companies with at least a $1 billion market cap. This illustration shows the stock report for NVIDIA. NVIDIA is one of the leaders when it comes to artificial intelligence technology. This specific image is a snapshot from May 25th, which was last week. And as you can see, NVIDIA had a market cap of $741 billion. Now, as of today, Tuesday, the market cap has already risen to over $1 trillion. So it is a large cap company, and large cap companies typically have a market cap of at least $10 billion. And as you can see, NVIDIA far exceeds $10 billion. So in terms of market cap, NVIDIA is a winner for me. Now, the second factor for selecting a winning stock is PE ratio. Now, the price-earnings ratio tells investors how much a company is worth. It measures the value of the company by comparing the price of the stock to its earnings. It tells you how much you're paying for each dollar of earnings. The PE ratio equals the price of the share of stock divided by the company's earnings per share. Let's go back to NVIDIA and take a look at its PE ratio. We see it has a PE ratio of 172. According to analysts, a safe PE range is 20 to 25, so 172 would be considered extremely high. Now, a high or low PE ratio isn't inherently good or bad when you consider the factors that are driving that metric. For example, when a PE ratio is low, it could mean that investors are losing confidence in that stock and selling their shares, driving the price down while the earnings are holding steady. A low PE ratio could also be down if the earnings grow quickly before investors take notice and begin buying shares that would drive the price up. Now, on the other hand, a high PE ratio could be caused by a flux of investors jumping in and buying and causing the share price to rise while the earnings remain the same. Or a high PE ratio could mean the company is positioned to really grow, triggered by investor confidence. Now, if you've been paying attention as an investor, you know that artificial intelligence has been driving stock prices up at a rapid pace lately compared to other stocks, and NVIDIA is at the forefront of that surge. A lot of people are jumping in as FOMO investors, that is, fear of missing out, and it's driving the share price up rapidly, which could explain why the PE ratio is so high. Now, when I'm evaluating a company like NVIDIA, I look at other companies in the industry and do a comparison to find out if this is some industry-wide trend, okay? So that's number two. The third factor for selecting a winning stock is volume. Now, volume measures the number of shares being traded daily or on average. Now, I tend to invest in stocks with high volume. High volume stocks typically trade at a volume of 500,000 on board shares. Now, there are exceptions to the rule because you're weighing more than one factor. Taking a look at NVIDIA, we see it has an average volume of 39 million in stock activities. The daily volume is probably double that amount. And remember, we're looking at May 25th, so it has far exceeded that now. And with this type of volume, this is a winning factor. The fourth factor for selecting a winning stock is stock rankings. I like to look at how market analysts grade individual stocks. And there are market analysts whose full-time job is performing stock analysis. And they provide forecasts based upon past, present performance, as well as trends. And I check out their reviews on how they rank each stock according to whether to buy, to sell, or to hold it. Now, one of my favorite sites for stock analysis is TipRanks. Now, this is a snapshot of NVIDIA's forecast by 33 market analysts on TipRanks. They rank NVIDIA as an overall strong buy. As you can see, 26 analysts has it as a stock to buy, while 7 analysts suggest holding it, and none are recommending that you sell it right now. And as you can see from this forecast, NVIDIA has already surpassed their 12-month projected price of $375 per share. In fact, it got up to $419 per share today. So these are the 4 factors that I use to evaluate individual stocks. And what I've given you is an overview of these 4 factors. I really didn't deep dive into any of them. And there are other things that I look at as well, such as quarterly earnings and comparison with other companies in the industry, as well as in the news events that are going on. Since I started using these factors to evaluate stocks, I have to say that the picks that I've made have been all winners. And I used to invest in penny stocks, but I tend to steer away from those for the most part. If I see a penny stock that looks promising, I'll put it on my watch list, and I might buy a few shares before it starts trading on the stock exchange while it's still over the counter. But when I invest in a penny stock, I make sure that it's money that I can afford to lose. Now, this 4-factor evaluation is what works for me. And quite frankly, I don't believe there's a better method out there, so I highly recommend it. However, do your own due diligence. And if you come up with something that works better, by all means, you want to use that. I just want to help you to avoid making costly mistakes like I did initially. And when it comes to picking winning stocks, my advice is for you to invest your time doing research before investing your money. And if researching individual stocks is just not your cup of tea, then just stick with index funds and ETFs, okay? I hope this information has been helpful. If you enjoyed this video, please like, share, comment, and subscribe to the channel. I'm on my way to 2,000 subscribers with your help. So please click on the notification bell to receive an alert each time I upload a new video. And until the next time, take care and bye for now.